you don't get something for nothing. You talked about the savers. What incentive do I have to leave my cash at a bank? Like, what's the net effect for me to get zero interest on my money? If I had $10 million in the bank and invested it in T-bills, there's a bartender at the restaurants we go to in Dallas who's making more money. So who's underwriting this spread trade?
Okay. Again, savers underwrite this trade, and the way I phrase it, which is very accurate, it's just not thought this way. This is a low rates, zero rates, effectively now zero rates are 100% tax on savers, because the Fed funds rate controls all of the short-term rates. So if you're a saver, money market account, savings account at a bank, you buy T-bills, your interest on that money has now been depleted to virtually nothing. T-bills yield 8 basis points. 8 basis points. So, I mean, it's effectively no yield. The bottom line is that you as a saver are actually giving your money to banks in the savings process. Because of the trade we just talked about, the fact is the lower the interest rate, the less the saver gets. That's what I call an anti-stimulus, because the historical, take 25 years of compounded T-bill rate interest is about 4.20 to 4.30. So instead of collecting 4.2% on T-bills or 4.3, you're collecting 8 basis points. So you're subsidizing banks with that forfeited savings. So investors, by the way, savers are being pushed to make riskier investments. I mean, that's one of the things that the Fed and the government want to achieve. They want to push you to buy other assets. Now, that's kind of been accomplished because corporate bonds have come down in yield, and the markets are now stable from last quarter of 2008. But the point is, you either stay where you are and collect nothing, get your principal back effectively, or you're forced into make risky investments, which could come back and bite you as a saver. Most people don't want risk as a saver. They want to keep their money. So this is a way of banks who borrow money for short-term inventories, to basically finance short-term obligations. When you lower the rate to zero, they're borrowers of money, generally speaking, so they get the benefit. Savers are effectively transferring their savings interest to banks.